Daily Fiscal Pulse for the 24th of July, 2026. Keep in mind that this represents a one-day look back on the flows, reflecting conditions as they stood into Friday's close, not real-time data. Let's start with what's currently animating the market. The dominant narrative centers on Iran and Middle East tensions. You're seeing headlines like US and Iran pause fighting. Trump dismisses concerns of dwindling stockpiles moving through the wires and clearly influencing price action. As always though, separating signal from noise is essential to understanding what's really moving. The headline number is a net fiscal transfer of $1.7 billion for the day. That's reasonable on the surface. What matters more is the directional shift in the near term. The 5-day flow has decelerated to roughly half what we've observed in the recent stretch. Tax receipts are shouldering most of the load here at $9.9 billion. That shows up in the ES futures contract, which closed at 7,448, sitting noticeably below the 20-day moving average of 7,543. The 20-day range is spanning 218 points and pointing lower. In other words, both the flow data and price action are aligned in their narrative. What gets more compelling is the medium-term picture. Government spending is averaging about $5.8 billion per day on the 5-day basis. Stack that against the 20-day average at $13.9 billion and you're looking at a meaningful slowdown. There's simply less cash flowing through the system, working its way into households and subsequently into market activity. The result is tightening financial conditions. The year-over-year lens reinforces the pattern. Spending sits roughly flat at $1,332.4 billion. No material shift in fiscal support to work into the analysis. For anyone considering long exposure to ES, that context deserves weight. The fiscal backdrop isn't exactly a tailwind here. Our conditions gauge reads -83. That said, nuance matters. Similar setups have shown up repeatedly, and despite reduced liquidity, the S&P 500 has still averaged around positive 1.5% over subsequent months. Prices don't track liquidity in a straight line. They can and frequently do push higher anyway. Positioning compounds the picture. Margin debt is hovering at the 100th percentile, which signals elevated leverage. Historically, readings at that level have functioned more as a cautionary signal than a bullish one. What's the practical takeaway? With fiscal flows sitting beneath year-ago levels, the shock absorber in the system is thinner. When headlines are positive, markets can still work higher at a steady pace. But when risk flares, like a potential escalation in Iran and Middle East tensions, downside can accelerate faster because there's simply less liquidity standing ready to cushion the move. A couple of dates warrant attention as we look out. The 31st of July marks the month-end settlement window, which historically can reshape short-term flow patterns. The 15th of August is when the next major Treasury coupon interest payment lands. Fiscal headwinds are showing up plainly in the data. What's worth monitoring is whether the pace of tightening is beginning to stabilize. The next meaningful move likely depends on how these scheduled flows actually materializes. That's where the opportunity sits at this point.